Welcome to Finance for World. In this explainer, we're looking at what is honestly one of the most fascinating and, let's be real, complex market environments we've seen in quite some time. Right now, the entire global economy is caught in this massive macroeconomic tug of war. Think about it. On one side, you have these record-breaking tech and semiconductor stocks just flying high, fueled by a seemingly unstoppable AI boom. But then on the other side, we're dealing with sticky, persistent inflation driven by incredibly tense geopolitics and some major energy supply shocks. It is a total clash between high-tech optimism and ground-level economic friction. So today, we're going to unpack exactly how these forces are interacting.
Here is how we're breaking things down for today's explainer. First, the AI stock market boom. Second, geopolitics and oil price swings. Third, sticky inflation and consumer confidence. Fourth, central banks hold the line. And finally, navigating financial vulnerabilities.
All right, Section 1, the AI stock market boom. $1 trillion. That's a staggering number, right? Well, Micron Technology just became Wall Street's newest trillion-dollar company after this massive 19% rally in a single day. And why? Basically, analysts are seeing a practically insatiable demand for computer memory right now. So Micron now joins the really elite ranks of giants like Nvidia, Apple, and Microsoft. It just highlights how much capital is absolutely flooding into the hardware that makes artificial intelligence possible in the first place. And, this AI enthusiasm, it isn't just an isolated event. It's a global tide. The S&P 500 and the tech-heavy NASDAQ both surged right into uncharted territory, climbing to records of 7,519 and 26,656. Then over in Asia, South Korea's Kospi index jumped a massive 4.9% to an all-time high, driven heavily by their local tech giants. Across the board, semiconductors are the undeniable engine of this rally, just pushing the boundaries of market capitalizations all over the world. Moving on to Section 2, geopolitics and oil price swings. Now, stepping outside that tech bubble, the reality is a lot more stark. Markets are incredibly sensitive right now to the ongoing conflict between the US and Iran. And we're strictly looking at this through the lens of market impact here. The volatility is immense. Recently, hopes for peace negotiations did temporarily ease some market anxieties, which actually pulled international Brent crude down to $95.73 a barrel. But as the situation remains unclear and fighting continues, we're seeing these sharp, totally unpredictable fluctuations in energy markets. It's really a precarious balancing act between supply fears and hopes for a diplomatic resolution. Think about this quote for a second, because it really gets to the heart of the issue. The closure of the Strait of Hormuz is a massive supply shock. Just to give you some context on that, roughly 20% of global oil and liquefied natural gas, along with crucial fertilizer shipments, move through that single route. 20%. So when tankers are pent up in the Persian Gulf instead of delivering crude worldwide, it creates an immediate, massive bottleneck. The effect is simple but devastating. It drives up the price of oil and sends this wave of painful inflation cascading around the world, hitting everything from your transportation to global manufacturing. Which brings us to Section 3, sticky inflation and consumer confidence. We've got a really fascinating paradox on our hands here. On one side, the U.S. Consumer Confidence Index slipped down to 93.1. Households are feeling discouraged, and that's primarily because those elevated energy costs we just talked about are pushing up prices for the goods and services they use every single day. But on the flip side, the labor market remains surprisingly resilient. Private employers are still adding an average of 46,000 jobs per month. So the job market is cooling off, sure, but it is definitely not crashing. This creates a very complicated economic picture. People are employed, yeah, but their paychecks simply aren't stretching as far because of that persistent, energy-driven inflation. Section 4. Central banks hold the line. Just look at this united front from the world's major central banks. The U.S. Federal Reserve is holding rates steady at 3.50 to 3.75% in this very cautious wait-and-see posture. The Bank of England, they're holding steady at 3.75%. Meanwhile, the European Central Bank sits at 2.15%, but they maintain a firmly hawkish stance, openly stating they'll do whatever is necessary to keep inflation on track. So across the board, central banks are keeping rates high. They are holding the line to combat the lingering inflation caused by those energy price spikes. The Bank of England's recent summary really highlights the almost impossible position central bankers are in right now. They openly acknowledge the severe uncertainty in the Middle East, but crucially, they admit they can't print more oil, right? Monetary policy just cannot control global energy prices.
But their primary goal is to prevent that higher inflation from persisting and embedding itself long-term into the broader economy. They're bracing for higher utility and wage costs as a knock-on effect, and that is exactly why they cannot afford to rush into cutting interest rates just yet. And we can clearly see how foreign exchange markets are reacting to all this maneuvering. Looking at the Euro-USD trajectory, the US dollar softened just slightly amidst some hopes of geopolitical de-escalation, while the euro recovered to the 1.1640 level. That upward momentum for the euro is heavily supported by the European Central Bank's strong, hawkish commitment to fighting inflation. It just goes to show you how hypersensitive global currencies are to every single word central bankers say in this high-stakes environment. Finally, Section 5, Navigating Financial Vulnerabilities. So, let's bring this all back home. What does this actually mean for your portfolio? How on earth do you invest in a world where tech stocks are hitting trillion-dollar valuations on the exact same day that global supply chains are being squeezed and central banks are flat out refusing to lower rates? To answer that, US Bank lays out some really clear guidance. In a tug-of-war environment like this, discipline is rewarded way more than prediction. Step 1. Maintain your discipline. The data is shifting way too fast to try and perfectly time the Federal Reserve's rate cuts. Don't even try it. Step 2. Build a broadly diversified portfolio. When traditional stocks and bonds are facing the exact same macroeconomic pressures from inflation, adding things like global infrastructure and structured credit can really help you weather the storm. And Step 3. Prepare for multiple macroeconomic outcomes. You need a financial plan built for resilience, one that's capable of surviving both an AI-driven economic expansion and a sustained period of higher energy costs. Which really leaves us with a defining question of this current financial era. As you review your own market positioning, ask yourself this: will the incredible productivity promises of the AI boom outpace the harsh physical realities of sticky inflation and geopolitical friction? Or will the gravity of the energy markets eventually pull the tech rally right back down to earth? Thank you so much for joining me for this explainer. It is a wildly fascinating time in the markets, and I hope this breakdown has helped you see the bigger picture.